Well, good afternoon, everyone. How are you today? As we move forward through the presentation today, I'd like to understand that there are bits and pieces from some of the Pinnacle Institute infrastructure and classes, as well as the subject that is at hand. So it should be a very interesting discussion for all, and let's get to it. Please put your questions in as you have them. Don't hesitate. I will be watching the chat, and I'll try to respond in kind as they occur. If you have any things that are off subject, go ahead and put them in there and we'll address them through the administration staff. Okay, so here we go. So this presentation is basically about locking in to compound and go for more. So when it comes to investing, trading, it's very important to understand how to do that and the context for doing that and the value of doing that. So this all-inclusive presentation should give you a good start on understanding that and understanding how the Pinnacle methods apply to that. So it's very important using the Pinnacle method of supply and demand to truly leverage its potential. As we go forward and we are trying to talk with a common language, knowing the Pinnacle method and the uses for supply and demand allow us to get much more out of it. And what it mainly does is it gets rid of some of that mental paralysis. Many traders doing many different techniques have issues with um, getting a little paralyzed in how they're thinking and the opportunities that they see in front of themselves. And that can be both in the entry, the target, how long to hold positions, as well as hesitations to move to a different solution. And most things in trading, there will always be opportunities or you'll learn something about yourself. And it's important to be free to go there with a little bit of comfort in that you're not completely inventing the wheel and you're moving into something that is comfortable enough for you to take that risk. As this is sponsored by the Pinnacle Institute, there will be opportunities for you to attend workshops in the next several days. They're on the screen right now. The website is down at the bottom. So if you like what you see here and you want to find out more, there's some introductory workshops that are occurring tomorrow and through next week for the more advanced folks as well. So take a look, take a snapshot of those. I will refer back to these at the end of the presentation. So if you miss it now, we'll see it later. For simplicity purposes and to keep it clear and not have us going off subject, this is all going to be available. This is all going to be centered around stock trading or long stock trading. So getting in our context at demand zones and following that trade to its conclusion. Options, futures, forex, all the aspects and securities that can be traded can benefit from the techniques that are going to be shown here, but we just won't use those as examples. So we have a good common understanding and there's no one that's left behind. So with everything we do, we want to know why we're here. What goals are we trying to accomplish? Now, this is not to talk about the goals of this presentation. Let's talk about your goals, just to keep them up in front of mind, to make sure that we're always filtering everything that we do through what am I doing? Does this apply to me? Can I use this in the future? Should I make a note about it? So I'm going to just real quickly go through some simplistic goals here, just to get us in that mood of we're in a learning environment and I want to look at and see if this applies to my goals or it can be something to enhance my goals or maybe be added to my goals. So most people are here to make money, increase wealth, protect the inevitable downside to investing, perform better than they did previously. They might have a specific goal that they want to get to, and we'll talk about those specific goals in a little bit. Many people want to get rich fast, which is an admirable goal. And I'm not saying that that can't happen. I'm saying that I'm just reflecting that that might be something out there. If anybody else has a goal that they would like to put in, please don't hesitate to do so. Hi, Romo. Many people, more of the soft skills perspective, they want to be more independent. They aren't comfortable right now doing everything they can in their investment world, and they just want to be more independent. And that could have many different instantiations, right? We could be more comfortable. We could be on the bench because we're fearful. We might have our money with a financial advisor and we just want to get out from under that financial advisor. So there's many examples of what that independence is, but you know what your independence is. And in most cases, anybody that's at this seminar or other seminars is trying to get more and more independent. Some people may not know what their goals are, which is very valid, right? It's a very complex environment. And as you experience more and more things, it can become a little more scary for a lot of folks. So they're not able to lay it down on paper what their real goals are. So through these seminars, and again, welcome here because I think this might help you move forward a little bit if you're really stuck on many other things. In these SMART goals, at the right upper right of the screen, those are the basics. That is the industry standard for how to do a goals, and one of them is realistic. Now, realistic is not I'm trying to overshoot what everybody thinks I can do or anything, but it's realistic on base what you can do. If you feel that you can do X, Y, or Z, make it part of your goals. Don't limit yourself. Don't limit by what we're going to show later in the seminar here. I'm going to show you some kind of implied limits that people think they have, and we're going to challenge those a little bit. Hopefully, you'll challenge them in your own mind, and I won't need to call it out. Right? The next thing, just real briefly, I've put the screen in front of you. This is an example of one of the class slides that we have in the investing class. Um, just goes through why don't investors reach their goals. I'm not going to talk about everything here. You can read them for yourself. But basically, there's a lot of things that come in and influence people that make them either tentative or too aggressive, so they can't reach their goals. It can be news events, it can be news people, it can be the confidence of the person in their skills, lack of confidence in the market. All those kinds of things can hinder a person from reaching their goals. Another example of something from a class is why should I choose specific stops? Why don't they work out? In most cases, I'm going to go through a quick list here as fast as I am humanly possible, and the the reason being is there's a lot of drivers to why people get into stocks, why people exit stocks, why people don't get into stocks. And I want to step through those in a way to kind of get our mood and understanding of where we're at when we're investing in stocks. A lot of people, their financial advisor drives the boat, and that's why they do it. Or they saw it on a website. Or the emotional side of things, this thing's going up, I just need to get on board. A lot of people like dividends, potential for great returns based on the history of that stock. So getting in today is going to work for me. Everyone is. So a lot of examples this year, people just jumping into things, the meme stock, etc. Many people have this fundamental choice where if it's number one or two in the industry based on sales or capitalization, that's a rationale for them to be in that stock and hold it for a long period of time. Celebrity discussions, the fundamentals of the company, to get a diversified portfolio. So some people will get into things, they have this diversified portfolio. Other people want to hit a home run, so they'll buy the really cheap stocks thinking that they're going to get, 300% increase and all that kind of stuff, or something new was recommended by a host on TV. Many people, unfortunately too many people, just consider it to be fun, to speculate, to be right, all that kind of stuff. Other people, again, back to the fundamentals, they like to get a dividend. They really enjoy having a dividend. Again, just like the fun side, everything, the thrill of being right. So there's kind of an ego thing in there for a lot of people. social aspects, want to hit that home run, whether it be uh, picking a bunch of stocks that are recommended by some entity, or seeing a stock value being so low, they're assuming it's going to go from $12 to $15 or $50 or whatever it is. They have that excitement of the stock market. Some are, again, fundamentally or technically hedging this against something else. A lot of family legacies out there. My 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 family is not immune to that, where uh, the parents would own stock since they were kids. All right, or family member gave it to me, or the 4% rule. So the fact that someone's in more than 15 stocks may be just because of the 4% rule. So they may really like some stocks, but they don't want to go there because they have that rule, that kind of the financial advisors drive. But many of the things that are here are due to human speculation. This is the personalization of the stock market for people. And that can be good and successful, but it can also be bad. And I don't want to discount all of these things as keeping the enthusiasm up and all that kind of stuff. But most of these things have to do with the human nature of things. But why don't investors reach their goals? So they can be enthusiastic and have all this advice and all that stuff, but why don't they reach their goals? A big one is they enter or remain in their security for whatever reason, whether it be influence from others or their own biases or whatever it is, but they'll stay in that thing when they likely shouldn't have. They also won't be in their chosen security when the security is most likely to go up. You can love a company and all that, but there's always an opportunity in the market from a time perspective of, is that the best time to get into that position or stay in that position? And lastly, they lack the processes or plans to execute this consistently. With all the influences they have, they treat one company different, one stock different than they do all the others. And that leaves all that exposure for more of those inferior drivers of investment choices. Not that they're without value, but they may be inferior to other drivers of investment choices. Okay. So now how do they make their goals? Well, how do they exceed their goals? There's people out there that, you hear stories, again, the whole list of human influence things. What are the reasons people exceed their goals? How do they do that? Well, the word in the industry is you always have to take more risk. The horizontal here is risk. So the risk grows here and their return will get higher. So simply by being more aggressive, they will make more money. Is this true? Is this true? Well, it's probably not. That's where they probably get into more trouble, right? A novice out there playing the world with a bunch of people that probably know a lot more than them. Probably not a good approach to take. But how do regular investors exceed their goals? Well, there's really only a very simple formula for this. The Pinnacle methods drives this home in everything that we do, and this is that important. And number one on the risk is they manage risk. If you don't manage risk, you can't, and you don't protect that downside, you're not going to exceed your goals because it will become overwhelming in most cases. They also don't waste time. So if there's money sitting doing nothing, they look for that to do something in order to keep the most positive uh, status in the position of their money and their attitude about the investments they're in. They also will act when opportunity knocks without forcing it. People that are too enthusiastic will force things a little bit harder than people that are sitting back and waiting for their prices, whether it be an entry price or an exit price. The people that act when the opportunity knocks, and not all the time, have more chance at exceeding their goals. And the most important thing in all of what we do in trading is they have to follow a consistent process to support all three of those: managing risk, don't waste time, and act when the opportunity knocks. So that's how people exceed the goals. Very simple, short list, not the simplest thing to do, of course. Additionally to those, these are some principles in the Pinnacle methods that are general principles that allow us to get to where we want to be. We enter investments only when they're on sale. Now, remember, this particular seminar is just talking about buying stocks and selling stocks, okay? They get out of investments when they meet their plan goal, right? That's very important to plan for every trade what your goal is for that trade, and not just focus on the entrance of things, but the entirety of the lifetime of the trade and the expectation of that trade or investment. Also, we want to sell or release an investment when it isn't working as planned. We want to stop out or get out. We want to prepare for the next best opportunity. If we focus on the opportunity in front of us and the one that we are watching or stuck in is a dog, we want to get over to the one that has the higher probability of giving us the return that we want to get. And those probabilities do change over time, and they change based on the charts and the instances in the news. It becomes more evident to be able to act on those things when you're using the Pinnacle method and supply and demand technology. We also want to respect the value of time. Like I said, time has or time value of money is important in investing and in all kinds of trading, but mostly in investing. And we'll talk about that. And we talk about that extensively in the investment class. All right, moving on. We have expectations in the industry, and I want to make sure that we talk about those things. Regarding the S&P 500, the industry says that investors can expect a 9 to 11% return on investment typically. Of course, they talk about past results, there's no bearing on future results, etc. But the reality is, on the right in the screen right now, you can see this is the yearly profitability of just being in the S&P 500 for the last 100, not quite 180 years or whatever. And you can see a lot of green on the top, kind of maxed out at 45%. And there's some red opportunity. It's probably 2-to-1 green to red, somewhere in there. Now, there's long periods of green and there's short periods of red for the most part, and that's typical. Now, this is it. This is all that you can get on the S&P 500 for the last 80 years, whatever. You can at most get approximately 30%, and at most lose about 40%. Of course, timing is everything, and these are year-to-year numbers. It might have been up or down more than that during the year, but this is how it beginning to end of year resulted. To exceed, whether on the downside or the upside on this, you're considered an outlier. So if you're getting more than 9 to 11%, you're considering an outlier, or that year is considered an outlier. So that's kind of the baseline that we use to measure ourselves against. Not necessarily the S&P 500 every year, but for longer term investments, you're thinking about, I want to get about 9 to 11, let's just call it 10% a year. But of course, past performance is no guarantee of future results. This next year could easily be a big red candle, or it could easily be a big green candle. There's no way to know which one that is. So if we're limited to expecting about 9 to 11%, how can we change this paradigm to kind of take control of this for ourselves? And that's where this presentation really comes in. So all up to this point, it's all been set up. And we're gonna see some examples here to talk through to understand how investing psychology, behavior, and execution matter. This is an example of a stock. Doesn't matter what stock it is. As you can see, it was kind of on an uptrend, if you will, right through here, kind of on an uptrend, and it came down and it hit this area here. you can see right here, kind of created a head and shoulders pattern, and then it trailed off. Well, let's say our example trader entered right there, which from most people's perspective is they're expecting to be bullish on this item. So they hit entry here, and they don't have a stop, and they don't have a target. So this is how normal people would invest. They would just buy this stock outright. Now, for the next 4 months or so, the stock just kind of trended down, right? It was losing money. Gave a few moves up, but basically was moving down. So for 4 months, it's gone down, and it's lost somewhere, over 3% in the 4 months here. And it's obvious to most people that observe that this wasn't what the investor expected. They wanted it to go up, or they wouldn't have purchased it. However, without having any rules, they of course wasted 4 months of time, and they paid 3% for the honor of losing that 4 months of time. Okay. The thing that we want to really draw out here is the normal investing model, and this is it, is now going to be challenged. This model wasted 4 months of money time. It lost money. And if we had got out of this, that money could have been put on something that was going to deliver. All right. So if this had stopped out, let's say it had stopped out here, we would have saved 2.5 months worth of time value, or time money value, to get into the next opportunity. And you can bet that in the time that this occurred, there was plenty of opportunities that weren't this particular stock. All right. So respect that time value of money. That is the number one value of the Pinnacle method when it comes to investing, as well as the compound investing strategy. Now, the next example here is called beta. And it's an example of a stock that's moved up dramatically. And this particular stock, again, is unlabeled here, but some people can probably guess what it is. It moved up pretty dramatically over several months. These are daily candles, by the way. So this is about, again, 4 months or so. It got an entry here, and without any stop, it was continually moving up. Now, as this did move up, we found that there was opportunities to take some profits. So moved up very quickly, came down and got the entry, then moved up quickly, came down. Okay, so it moved around, all right? Kind of a range situation here. So when it was up 25%, which would have been right about here, what would most people have? What would be their emotions? They're up 25% in a particular investment. They'd be, oh, wonderful, wonderful. But I don't have a target. That's not my way. I bought this thing expecting it to go up, and I'm going to hang on to it. So then time went on, another month passed, and then it decided to take off, validating the person's mind that my being patient was the right thing to do here. Okay. So there's a little mind trick that's going on here. So now it went up, and now it's up 100%, and the person's patting themselves on the back. They're showing them their friends. They're very excited, right? I hit it. I nailed it. I'm going to change my life with this trade. So they're up 100% now. And again, they're not thinking about getting out. They're not thinking about doing anything with it. They're thinking, it's up, I should let it run, right? How many people have had that thought? Now it's up, I let it run, great. And they were, in this case, correct. So now it came up to here, and it's worth 250%. They still don't have a plan to get out, no intention of getting out. They have no stop. They've just entered the position, and they're just riding it out. They bought the stock, and they're just holding it. All right. And then the turnaround comes. So here they're elated. They're up 250%. They're geniuses. They're telling all their friends. And now it goes down 40%, where all of a sudden they've lost their friend's phone number, and things have changed, right? In this particular case, the person that did get in on a good number is a little less than enthusiastic, even though they're still at nearly 100%. a profit, right? So there's some emotionality that goes into here. And what is this person? So this person does get out when it's coming down. Now, as they do that, what are they going to do with their next dollar? That's the key to this whole situation. So what are they going to do for the next dollar? If they have said, well, I did it once and I'm going to find out to do it again, that may be the behavior they do. Okay. So they gained 100%. They're geniuses. They can tell their friends. And then what do they do for the next trade? That's what is important to having a consistent process. And we're going to get into a little bit more of that now. So I just wanted to give you an example of the reality that what people are dealing with when these things go up and how it affects their behavior and also restricts their behavior on maybe being the best, smartest trader they could be. All right, so here's a gamma example. The gamma example is showing, using the Pinnacle method, how you can take a little different attitude on this. And this is setting a trade. In this particular example, the trade was set right here. Once this came down and did a test, the trade was set right here. So for these days, just waiting for the trade entered, and the trade went really quickly to what we call a target at a supply zone and paid off. And the details of that are over here. In this particular case, there's a note here that the trade could have been set here when this came and got a little closer. You didn't have to have the money sitting aside. It could have been set here. So it was really 8 days on this trade, which would multiply the ROI by 5. So this could be a 21% ROI relative to the amount of days it really took for that trade to go. But nevertheless, this trade had an entry, had a stop, which was not violated in this case, and had a target in and out for a 4% gain in a very short period of time, 7, 8, 9 days or whatever it was. Okay, so this is a model to be repeated. So by choosing this trade, it was not chosen on I love McDonald's and McDonald's is the best company. I want to hold this company forever. It was based on McDonald's price action. And McDonald's came in trusting McDonald's because it was a solid company, that the demand zone would work, etc. And then accepting the money from the transaction and getting out and then looking for the next best opportunity, which might be McDonald's competitor or Coca-Cola or whatever it is, doesn't matter. As the trade satisfies itself, that money is in the bank and the next opportunity is there. Now, many people, when they see this move, want to stay in it because they say, oh, it's going up. It's really strong. It's gonna keep going up. Now, in this case, I don't have a trick for you. I don't show you the next and tell you that it went down. However, the attitude is there and the emotional dedication is there, that I really don't want to get out. I want to stay in. However, for someone that's very happy with a 20% return on investment, a yearly rate in 9 days, they're happy to take that money and go look for the next best opportunity, because the opportunity to go this move from here to here, the opportunity is there, yes, but is the probability there? And that's the nut of it, is the probability that if I don't get out here, that I'm going to get that same kind of move. It's probably not as likely as it was when I got this strong demand zone down here. Okay, we're not in a demand zone here, we're in a supply zone. All right, so keep in mind that this is the model for compound investing. All right, a little bit of a side move here, just to kind of put our brains in a certain area. If you gain 50% on 10% of your account, okay, so for the really aggressive out there, if you gain 50% on 10% of your account, the entire account value increases 5%. That doesn't seem possible, does it? But that's how the math works. So if you have $10,000 and you gain 50% or $5,000 on that, it would increase a $100,000 account by 5%. Now, we talked earlier about the S&P 500 at basically 10% for the year is an average. So that's a pretty good thing. Here in this particular case, if I focused on 10% of my money and taken trades in demand and got out of it and accumulated 50% in a year, that would have attributed to 5% of my whole account growing 5%, right? So it's not really a wow moment, but some people see that and like, oh wow, you mean I didn't have to put 90% of my money at risk in order to make 5%? Well, that's pretty amazing. Now let's look at the next one. If you gain 100% on that 10% of your account, the entire account goes up 10%. Same thing. I didn't put risk on that 100% of, or that other 90% of my account, but I still got a 10% return. This starts that S&P 500 average number to look pretty meek, doesn't it? Okay, that's what I want you to see out of this. Now, if you gain 100% on 50% of your account, of course, the math shows you gain 15% of your account. Okay, so now I'm not saying you should risk 100% or risk 10% of your or 15% of your account, am I? I'm saying if you just increase that number that much, that's the results you get. Okay, so making money in the stock market is more of a math problem and less of a fundamental uh, picking stocks problem. Okay, you could pick stocks for the other 90%, and the whole account could go down 30%, right? But if you don't have to do that, you have much more control of the situation. So why do we mention these? Again, back to if the historical return is 9 to 11%, and our goal, and most people's goals are, and it might be 30% this year, but historically, but if the goals that people use to frame their success is based on what they can expect from a conservative type investment, that should be a baseline, and then beating that baseline is the goal. And these are just examples of what you really need to do to beat that baseline. Now, for the people that are new to this and say, well, 50% gain, that's huge. Stay tuned, and you'll see that if you just accumulate your gains and don't give them all back, getting a greater return on your trading is within reach. Now, back to the compound investing. Now, if we have a baseline, everyone understands compound interest for the most part. So compound interest in this particular case is you have $10,000, you put it in a CD or whatever, and don't make fun of the 1.2% interest rate. I know people don't get that anymore, but if I put it at the real interest rate, it won't look like any money was made with this. So I didn't want to do that. So we go, if it's 1.2% interest rate, January of any year, and we have a fixed rate, we understand that our monthly gain is small. It's down here. It's in the somewhere in the $10 or $11 per month. Okay. Now, and so it doesn't look like this is rising very much, and it's not. However, over the year, each month, your account grows a little bit. So at the end of the year, you have about $120.06 in profits. So your entire account becomes $10,121. All right. So that's what compound interest does. It grows the account, and in the case of a fixed rate, it grows the account in that fixed rate. So at the end of a specific term, it's worth that much more money based on the interest rate. Fairly simple. Okay. Now let's look what if we do the same kind of attitude. How can we think about that conservative investment of compounding interest, which is considered to be a conservative investment? Let's look at that same attitude. Let's take that same filter and look at compound investments. Now, we're assuming here that we're using Pinnacle methods. We're using good entry and exit strategies. All right, so that's very important to the context of this. So, compound investing can also reduce overall risk by locking in investment gains. So the idea is you get into investment, it gives you your gains. You define an opportunity where you say, okay, that's enough on that investment. I'm happy. I got my good demand zone. I got my bounce. I got my move. And to get to my, call it 50% goal for this bucket of money for the year, I don't need this thing to go to 100% profit. I can just accept a really high probability move and then release that money and go back, put that back into the next trade. Okay. So by locking those gains in, when that situation is ripe, as I say here, when it hits a supply zone, or when I've hit a number that I'm happy with, we can free those things for the next best opportunity. It also, if you see the graph, which you'll see in a second, as you move up, as you have the confidence of getting entries, getting targets, and moving up in your account, you will find that the movement in a positive direction and remaining steadily positive, if you're so fortunate to do so, can leave you your break even. Let's say you got in and you did, and you truly said to yourself, I don't want to lose 40% of my account. That would be disastrous for me. It'd be horrible. But if, as you move up with your investing, you find that, really that bar that I started with, where a fixed number, whatever that was, a certain percentage, let's call it 10% below my current account value. If I just move that up a few percentages every month or every year, whatever it is, where it's not reasonable that it's going to be violated because I'm doing things a little differently and I'm moving away from where I got in, it can give people a lot less anxiety to know that they're in control of the situation, they're managing their downside, they're managing their upside, as well as growing their accounts as they wish to. There's many people that aren't in the position of feeling like they have control over that, and this is a methodology to try to help get them a psychological uh, answer to those issues. All right, so um, moving to the looking at the current situation and where the situations might go for someone, let's look at the buy and hold, the normal way that people are buying stocks. They get, again, all those human factors. Someone advised it. Let's just do it. We got into a stock, so we got into a stock at this level, and let's just say that's $350, and they want to just do a buy and hold. So by holding it, they're being introduced to the volatility of stock, and the stock market goes up and down, over time. And in this particular example, and this is just an example, folks, um, this particular stock went from, um, oh no, this isn't the cost. This is the net gain. This is not the cost. Doesn't matter what the cost is on this one exactly. So at the end of this period or of a year, this one went up 17.37%. We go, yay, woohoo, everything's great, right? So great example, Randy. What are you doing? Notice here what happened over this time frame. This is showing the monthly gain. So right after purchasing, it went down, and then it went up, and it went up for our side. And think about the mentality of the person. Okay, oh, it's going great. I'm up almost $1,000 here, and then it starts going down, and now this goes down, and I'm still above, but then I'm negative for the month. So I get a report from my financial advisor, and things aren't going well. So I go yell at my financial advisor here. But we're below where we lost $500 or in value this month, and then it moves up again, then moves down again. So this volatility has an emotional cost to it, because going negative for any investment, to most investors, um, unless they're completely hands off and all that, is a concern. But you're here as a trader nominee, so this would concern you as a trader. You would not like this. You would say that this trade is failing me now, or this month, or these 2 months, right? So be aware of that. That is the normal model that people have, and this is something that went up. Okay, in the long term. If this had gone down, you can imagine how this could have affected the psyche and the attitude of the trader. I probably should have put an example on one coming down. But how do these feel? People don't like that. That's not something that removes anxiety. So in compound investing, not only are we getting paid to wait from two perspectives, and like I said, this is from the investing class, so there are ways to get paid to wait for your entry that we won't talk about now, but you're also getting paid to wait to get your price. By waiting to get your price, your profit zone is therefore increased that much. If it's got to come down to a demand zone, and it had to work its way down to a demand zone, you are in fact adding to your odds, and you're also increasing your profit zone, which also adds to your odds. Now, as we wait and we get paid to wait, the effect of that is because we have a greater potential for it to move up after it does finally get entry, that increases our probability or decreases our probability of it going down below that as well. So by waiting for that thing to come to us, we are in fact increasing our odds that it won't go past us into the negative territory. So that's what this graph represents. It represents not only waiting to get paid, but more frequently moving up after I get entry. Now, it doesn't show all the trades here, it just shows the attitude of it. All right. Now, in this particular example, it's limiting our downside because we're stopping out when things go bad quickly. We're not waiting. We're not like that first stock graph I showed where things were just trending down right after the purchase. It was kind of going sideways and it was working its way down. Well, in those cases, and it could have been any of the ones on here, we would get out there and go look for the next best opportunity. Okay. So our stops are getting us out and limiting our downside, which again is something that your financial advisor doesn't do. You never hear CNBC say, get out of this, do they? They always talk about getting in things, but very rarely do they talk about getting out of things. So you got to control that yourself. And the way to do that is with the Pinnacle methods and technical analysis. So if you get out and you take that money and you go look for something as an opportunity, let's say you got out here, but then you found an opportunity here in this case to get the upside working for you again. That's what happens here. So by getting out of something and looking for something to get in, you could have potentially more stable returns. Doesn't have to be greater, but more stable returns in the direction that works best for most people, both psychologically and financially, to have the assurance that they're in control of their downside and they're also controlling their upside because they're taking the best opportunities that are in front of them. Okay, makes sense? So that's what that's doing for us. So to be a little repetitive here, by accepting investments that are supported by demand for your entry or your holding decisions, as well as target out with a plan, it has a strong positive impact on the overall return that you're going to get on your accounts. It smooths those net increases over time by avoiding participating in the downside. And while the gains, and when you take a gain, it's permanent. Until you decide what else to do with that money, that gain is permanent. That's a very important thing to discuss here because many people, when you get out of something, of course, there's the regret. It continues to go up, and there's some regret about that. Okay, that's very normal. But when it continues to go down, it decides to go down. They're like, "Hey, that was awesome." But in both cases, if they got out, they're on to the next thing and they're looking for that next opportunity. They don't need to dwell on what happens to that thing afterwards because their plan has completed. Whether it be stopping out or whether it's been targeted out, their plan is completed. Except for what I'm going to show a little bit. Oh no, I already showed it. The McDonald's example where there's multiple targets, and then you have the opportunity to continue to manage the trade if you stay in the target, or if there's a pullback in that thing to a new demand zone, you can get back into the same item. There's nothing saying you have to change to a different um, security. However, that may not be the one with the best opportunity that's in your view or your radar screen. All right, this is just again an example. Entry impact when you're doing any kind of investment is huge. And the Pinnacle method, and again, this is just an example. If we're waiting for it to come to us rather than jumping into something for other reasons, this is just one example of how even though our target is the same, whether we jumped in or whether we didn't, we can have a much greater return on investment for that particular thing. And this is a shout out to all the people that do other things. It works for all types of securities within the stock market, whether it be stock, puts, calls, or anything. The value of being patient and waiting for your entry increases your odds, increases your profitability, increases your confidence, and through all those things, we get more competitive with ourselves and more consistent in what we do. Oh, here it is. I thought we had done this, but when they have this is an example showing multiple targets, and this was April of last year. So by taking this attitude of freeing money up as we hit targets, you can see that in wonderful entry opportunities, we don't necessarily have to have one target. In this particular example, the entry was here. 300 shares were purchased and multiple targets were defined. This target was defined on the closest supply zone. This target was defined on the next supply zone. And this target was defined on the new all-time high, as you can see there. And through all of this, they all had different times that they were in the trade. One moment, please. You can see that they were all um, different time frames, but they happen pretty quickly in this particular case. However, it shows an attitude that you can be in this same thing. You can trade the same thing a lot, and you can have long-term stuff and you can have short-term stuff, but it's always a good idea to think about taking the high probability profits to help, if you will, pay for staying in the other ones, or just to have that. If all of these trades had just gone to here, bounced back to this demand zone, if you didn't have any target here, you wouldn't have had any money to get in here and absorb this stop out. Okay, so by putting high probability and taking money, and you could have got out with 300, all 300 here as well. It doesn't matter. But the attitude is, if you take a little bit, you move the bar up a little bit because you've got money in your pocket from this trade. It does take that money off the table and allow you a potentially additional entry on this or anything else. However, this locked in, $1,100 on this trade in a few days, and it was on the way to making much greater return. But the incidents here are different. This is a very good supply zone as well. So taking more to this supply zone, or taking 200 here and not having this one, that's all what you would figure out as you see opportunities. However, the attitude of taking something off to move that bar up to accept that, hey, I got a great trade, let's get out of that and we'll look for next opportunity, but let's declare victory there in this case, was a reasonable thing to do if you have an attitude that I'm just trying to beat that 11% a year, right? Getting $1,000 in 5 days on what would that have been, about $20,000? That's pretty good, right? 5% in 10 days. That's not bad. You have to think about extrapolating that. So your goal is to have a percentage, get a certain percentage for the year or exceed it. And the way to do that is keep stepping forward, keep moving up, look for lots of opportunities. There are tons of opportunities in the market every day. Some days better than others. Sometimes we get all things linking up and it's a perfect day for entry. Other days, it's a little more work. However, from an investment perspective, we're really about taking our big money and trying to just move that ahead, chugga, 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 without taking the big downside. And by making sure your stops are good, making sure your entries are good, you've done most of what is necessary to make your targets be good. All right. So this particular one, um, has a lot of information here, but it's a nice picture to see how things can work very well from managing targets and accepting targets and leaving some money on. All right, so real quickly, we're getting at the end here. I want to just step through protecting positions. Now, we talked about just getting into trades and how you manage them, how that moves your money forward. But truly, there's three basic things that drive the whole process when it comes to managing your investing and compound investing. Is the entry. How does your entry protect your position? Well, by waiting for a quality entry as a starting point for investment, it has a built-in cushion from retreating below that entry, does it not? That's what a supply zone is. I'm sorry, that's what a demand zone is. It's protection from the price going lower. Now, how good is that protection? Well, that's to be determined by the price movement in the markets. However, just by waiting for that gives you a little edge, maybe a big edge, on not being stopped out. But it also gives you a protection. The protection about being stopped out is actually moving away from where you would get stopped out, right? So that protects your downside by waiting for the good entry. I hope that makes sense. Also, like I mentioned earlier, by waiting for your entry, your profit zone is probably expanded as well. So let's say your profit zone was $10 for this particular stock, and by waiting for the demand zone, it became $14. Well, it's not true math problem. You can't say it's 40% better, but propensity of stock markets to fill the gaps when there's a profit zone is what we all trade for. We trade for the profit zone. We're not trading for the entry, but the entry, um, by waiting for that entry again, increases the profit zone, which also increases the propensity for that thing to want to fill it. Long, remember, we're talking about long stocks, quality stocks, of course, that have a goal to get to their all-time high. That's what all stocks have. So a good entry on a demand zone, the real major target for that, not a trading target, the real major target for that is to get to the next all-time high, because that's how the CEO works, right? The other piece, or the second piece of trading, is stops. All investment should always have a well-planned stop, and a well-planned stop. Now, for investing, it may be different than a day trade on a futures stop, right? It can be very different. And if the entry doesn't hold, in most cases, well, let's say in every case, it's best to stop out, because that demand zone didn't do its job. And if a demand zone doesn't do its job, there's somebody else that wants to do that job. So you take the money out of that trade or that transaction, and you go to what does have the better um, opportunity. And it may be a demand zone in the same security that's lower. That's very valid. Doesn't mean you have to be, down on Boeing. Could be that Boeing just didn't quite reach the imbalance in demand that it needs to make the move that you're looking to get. So you can still trade the same stocks if a demand zone gets broken, but you don't want to carry that loss all the way down to that next demand zone. That's just not a high probability way to do things. It's taking too much risk for the or what you expect to get out of that trade. Yeah, writing a loss is down for non-members. Um, the stop also can become your downside target. So as you do have a position like the one I showed earlier, where it was going up exponentially to the high side, as you do have one that is moving like that, moving your stop up becomes your downside target. It's not a stop anymore. It's really a downside target, meaning I'm going to target out for profit here, and my stop is going to protect that happens. Okay. Also, a very valuable technique in investing. Now, trailing stuff in day trades, I think most of us know it doesn't work real well. It doesn't work as consistently as we want it to. But in a major stock move, it has much more propensity to work well for you, in that the stock doesn't move $100 in a day generally. It's a chug to get to that target, or that high value that you don't want to come back on, like that example I had before. So you move your stop up, and it just becomes your downside target. I'm going to target out here because I like making that much money on this trade, and I don't want to risk that downside to give it all back. All right. So that's my positive spin on trailing a stop. And then the third piece, of course, is the target. As the target is determined right when you put your plan together, I believe, and I do this consistently, is I protect my downside with the target. Remember how I said the money gets off the table, it goes back in, and it's basically the trade's over. Your account has moved up according to that target, and it's just a new day. So the target allows me to protect the downside because I'm no longer in the trade. Okay. So for those that have angst about, news for this stock or this stock, hey, if it hits your target, you're done. You don't care what happens to the stock. And in fact, you might want it to drop to be right or to get the next opportunity in that particular stock. But the target protects the downside because it accepts the win. Okay. I hope that makes sense. As a side note, that is something that your financial advice or institution would never recommend, right? They give you reasons. Okay, you got a tax hit. They come up with a bunch of stuff because they want to keep your money engaged, but they generally don't say, oh, you want to get out of that supply zone, or you want to get out after you've made $1,200 on that particular trade. They wouldn't say that. That's just not what's built into them. And you'll see many people will look to hedge, or they'll look to do other things, and we talk about that as well in many of the classes. However, isn't it much easier for a person to say, I'm up 5% in that, that's good enough for me, I'm going to just get out of that and look for the next best opportunity that's going to give me that next 5%? That attitude of just accepting success when it's in front of you is not something that the financial advisors and other people do. They say, oh, it's going well, stay in it, right? And a lot of people tell them to themselves, right? It's going well, stay in it. There's something about it, just because it's gone up, that means it's going to continue going up, which we all know is a fallacy. Now an investor may target out with whatever they said, and it could be a specific target, it could be a supply zone, it could be a date. You could set, when you get in a trade, you could say, you know what, I want to stay in this, through the end of the summer, but after that, I got to get out of this and get into something else. Now that could be something that's going well, that you just said, okay, enough already. Or it could be based on something about the company, and the schedules of the company, things like that. Maybe before earnings, I want to get out before earnings. Um, but you can also get out of things that, not to rebalance according to what you've got, but you may want to get out of trades that have done their good for you, and get into something that's going to have the higher probability of getting a bounce. So there's no reason to stay in something if you're not enthusiastic about its next move in your favor. Right? A lot of people do it with news events, but that can be overdone as well, right? Because that's what the financial news just does, is they try to make you feel like the market's going to drop. So you got to be very careful with responding to news events, because a lot of times, um, let's just say they're not accurate, or they don't do what they're going to do, and then here you are, you've jumped out of something that might be premature. So it's best to follow your technical analysis and let that go through what it's going to go through, not only from a learning perspective, but from a consistency perspective, because you can repeat that. You can't repeat the news every week. As I talked about earlier, partial targeting is an approach that, for those people that really like to keep something in play, in the example I use, I shows 300 shares, and the 200 shares had specific targets, and that last third hundred, or I don't even know what you call that, but that last third is, that kind of that reach goal, but still it's got a trailed stop up to it, so it's not going to go negative. It's just leaving it in play to give the opportunity. That is, of course, a little violation of the policy, because you don't know, you can't guess where things are going to go. But for those that truly like to stay in something as long as they can, there is that caveat. And you can also, like I said, trail the stop up close, you get it to the point where you're not at risk of taking a loss on that particular trade, but you're giving yourself enough cushion to keep it going forward. That's done a lot in the indexes. Okay, then, so as we talked about, the entry impact is huge. We talked about that the targeting impact is huge, locking in those gains. That original loss line moves up. So if you had a maximum loss that you're willing to take on a your account or whatever, as you lock in these profits, that line is moving up. Uh, it's easier to understand. if you have money goals, for example, let's say you don't use supply to target out, and you say, for this particular trade, I'm taking $300 risk, and I want to get out when it's $1,200. You can do that very easily. The math is easy. You don't need to be involved with all that other stuff. You can just be chugging ahead to beat that 11% or whatever percentage you say. I'm just using that as a frame of reference. And of course, when you leave something in a targeting, they do have less odds than potentially other opportunities or that particular opportunity that you're in. You're not in demand when that thing moves up. Now, if a position moves up and creates a demand zone, well, then the attitude changes, right? If you find a new demand zone on its move up, then you can actually move your target up or your stop up to that demand zone, and that becomes your validation for staying in the trade. All right, easier to show it on a chart, but I won't be doing that today. And of course, the stop is huge. If you never or rarely take a big loss, if you capture your gains as the price moves in your directions, and you release those funds for the next best opportunity, you get all the benefits of um, making sure you don't take a big hit, and your psychological benefits of having some protection and feeling good about your trades is good. Um, One of the best things a trader can do as they go through their development is to be comfortable with a little bit of loss, a little bit of risk in the trade, and accepting that that saved you a lot of money. I realize it's hard. It's a very difficult thing to see and absorb, but the the benefits of taking a stop far outweigh any benefits that you get by having a great choice on a stock that takes off. If you are protecting yourself, you can take advantage of those big ones that take off. But if you're not protecting yourself, the big ones that take off may just get you back to zero or even below zero. So it's truly a disservice to yourself not to protect your downside, because it takes away all the good things you might do by letting something hit you big on the downside. So, question to the group: can you see this kinds of thing happening for you, where you can eliminate the downside, think about targeting it out at a level that isn't speculative, isn't based on nothing, but is based on a plan that you've put together to create that continual return on investment for your assets to get you to what your financial goals might be for your assets? Okay, so we didn't talk about any of the traditional things when it comes to investing in stocks here, did we? We didn't talk except maybe in a negative way. We didn't talk about any of those things. We talked about a trade plan to make money no matter what the security is, because of the context of the entry and the context of the target. Hopefully, those out there can understand how that simplifies the equation. You can be enthusiastic about Apple or Tesla or Amazon or Ford or anything that you tend to trade. You can be enthusiastic about them. However, accepting what they give you and nothing less, and letting them hurt you only enough that it doesn't hurt so bad. That's really the technique that we're looking for here with the compound investing. Manage your money to the downside, and now manage your money to the upside by taking the target, accepting success, and do it again and again and again. Does this make sense to everybody? So have a plan and stick to it. Whether it be compound investing or anything else, will allow you to put yourself in a position to do the best that you can do. And greed is good. Irrational greed is always rooted in a lack of plan. You may People may think they have a plan, but there's something else driving it, right? It's a gambling mentality, it's other things. But if you focus on a desired goal, that's a goal that's reasonable to you. And I'm not going to tell you what a reasonable goal is. um, then you'll be able to repeat that success again and again and again. So the Pinnacle Institute methodologies, we got many techniques working through these plans, and you can see from the content today, I wasn't just telling you how to get into a zone. I wasn't just telling you how to get out of a zone. That wasn't the important message today. The important message today is there's aspects of trading that no one talks to you generally about. And keeping the money, leveraging that money to make more money, making sure that you have a context for your trades at all times that's consistent with what you learn and what you know and what you've seen work. That's much more important than what you're trading. Your trading is in itself a valuable entity unto itself. The fact that there's this security, this cool company, or and all that stuff should be tertiary to the real opportunity at hand. It's the entry, it's the target, which is the only way you make money. The only way you make money is when you hit the target or when you get out of the position. You can't make money without a target. It's impossible. You can, well, maybe dividends. You can make money with the dividends you might get, but you can't make money with the target. So I wanted to focus on the target because that is what we all get paid from. And by looking at things and compounding and moving that account forward with a planned, focused effort, and that's what you're actually trying to do. You're not trying to pick stocks and feel good about that. You're trying to move your account up. I would say most people here and most people I would talk to on the street, when it comes down to it, they will express that they want to pick a stock. They won't express that I want to move my account up very regularly and change my life that way. It's just human nature. But you can't really reach your goals unless you treat it like a trading challenge. Okay, so we have many of these different ways of looking at the problem in a way that regular folk can truly understand and get value of. All right, so we also have all the other stuff that talks to the you know picking the zone to get in and here to get out and all the relationships and all the odds and answers beyond what I just talked about. But my talk today was about exactly what I said it was. So any other questions? Be happy to answer them. Okay. With that, I'll say good evening to all or good morning to some, and you have a wonderful day. If you are interested in one of the workshops, here they are. Take a picture. If you want to go onto the website. There's more information on the website. We'll tell you about those workshops, but they are um, very valuable to understanding where the Pinnacle Institute is, how we can help you with your trading and investing, and help you learn what you want to learn to be the best you can be. Thanks to the support teams, and we will talk to you later.